Work for Congresswoman Norton, and I would like to welcome you to Congresswoman Norton's Small Business Fair. This presentation, this seminar is how to finance your small business. We're going to have our moderator, Ms. Angela Franco. She is the president and CEO of Greater Washington Hispanic Chamber of Commerce. And without any further ado, Ms. Angela Franco.
Thank you. Well, good morning and welcome. We are all delighted to be here, and we want to thank Congressman Norton and all his staff for putting this together, because if there's somebody that knows how difficult it is, it's everybody here and me, because we do a lot of these events. So I'm going to give you a little bit of my background, and then each one of the speakers today is going to share with you a little bit of their bio and background as well. First of all, the purpose of this panel is how to finance your small business. Discover how to receive collateral support from the $13.2 million available to small business in the district, and how to attain microloans from community organizations. So we're going to be talking a little bit about microlending. We're going to talk a little bit about regular lending through banks, and we're going to talk about collateral and opportunities that are available to you. So I'm the president of the Greater Washington Hispanic Chamber of Commerce. I worked in banks for 20 years. I did small business loans. I did a lot of financial planning, and now I've been honored to be the president of the Hispanic Chamber for the last 4 years. Our organization has more than 430 members, and we have a foundation, and through our foundation we provide assistance to mainly Hispanic businesses in the metro area. We have programs in Arlington, in the district, in Montgomery County, and Prince George's County. So now, why don't we start with you, Jonathan? You can introduce so they're going to take 3-4 minutes to introduce themselves and give you a little bit of background, and after we'll begin with the program inside. Now, before we start, I just want to ask a quick question. Who's a business owner here? Okay, so who's interested and ready to get a loan? Okay, thank you.
Not sure if is this on?
Yes.
Okay, great. Hi, good afternoon. My name is John Higgins. I'm a commercial lender with Bank of Georgetown. You may be somewhat familiar with Bank of Georgetown, but we were founded in 2005 as a commercial bank. Have grown the bank organically, and I say that meaning that I've met customers face to face for the past 8 years, working with them to solve cash flow problems, help them buy buildings. I've been in business in the banking industry for about 12 years, working with small and mid-sized businesses, really being an advisor to them, coaching them through the process of looking at financing, if it's appropriate for them, and what their options are if I'm not the right solution.
Good afternoon, everyone. My name is Christina Stackamore, and I work at the Latino Economic Development Center. We're a community development center that was established back in 1991, and we have 3 core program areas: affordable housing, homeownership, and small business lending. So my role, I work in the lending department, and so I'm a microfinance loan officer. So my primary job is to go out into the community and identify small business owners who qualify for small business loans through our program. And we offer microloans starting as small as $5,000 and go up as large as $50,000. So in my capacity, I'm often the one who's on the front line, who's analyzing these business opportunities and presenting them to our director and to our lending committee. And I've been serving in this role at LEDC for close to 4 years, and my primary area of focus is Washington, D.C. So I've become very familiar with the D.C. community of small business owners. And my educational background, I'm a graduate of Georgetown, so I've been in D.C. even longer. I studied at the School of Foreign Service and in business and Latin American studies. Thank you.
Good afternoon. My name is St. Elmo Crawford. I am president of Digital Conventions. We are the digital signage advertising service partner here at Events DC. We manage all of the displays that you may have seen throughout the facility here at the Convention Center. I'm here today because I've actually worked with a number of the members of the panel here when we were first trying to start our business, and really have a kind of unique experience going through working with LEDC, working with Tim, work with the District of Columbia and their local disadvantaged business programs. And so we have a lot to kind of bring to the table in terms of, financing, trying to get started, and then really working with different entities in order to get those first couple of contracts.
Good afternoon, everyone. My name is Chester McPherson, and I am here from the District of Columbia's Department of Insurance, Securities, and Banking. We are your local state regulator. Not that the district is a state, but we perform the function, the equivalent of a state regulator. And we regulate insurance companies, locally chartered banks, and securities firms, investment advisors, broker-dealers. I'm here today because primarily I want to share with you a partnership of sorts, which is our collateral support program and also our CAP program, which are programs that we have jointly with lenders who are participating. A bit about myself. I came to DC in 1992 to attend law school and kind of fell in love with the city and have remained here since. And I have been with the department for about 2 years. Thank you.
Good afternoon. My name is Tim Flanagan. I'm the director of the Washington Area Community Investment Fund. We go by the acronym WACIF. WACIF is about a $7 million loan fund that specializes in small business finance, mostly in microfinance, but we'll go up. We're filling the gap between microfinance and commercial lending. We have loans up to $250,000, and we go as low as 10. Although we've made loans smaller than that, we made a $2,500 loan this year, which was pretty wild. And a little bit about me. I went to St. Joe's in Philadelphia. The Hawk will never die. And came down to DC for planned to be 1 year. And then I met a lady. And 7 years later, I'm still here, married with a 6-month-old. And so I've really grown to love the city and the small business culture here, and really look forward to continuing to build the small business support system that's here in the district.
Mm-hmm. Well, thank you all. As you can see, we have a great panel. So we want to make this as interactive as possible, and we want you to ask as many questions as you want and to really take something out of these. That is, if you want to apply for a loan, what's the process and what are the possibilities? So let's go into the programming side of each one of the institutions. So why don't we begin with Jonathan, and then go here, and then at the end, St. Elmo, you can share with us your experience getting a loan, and what was your challenges and what helped you to really go to the next step.
So what I'll do is I'll try to just summarize. Obviously, we're a community bank, commercial bank, focusing on doing loans for small businesses. That's why we were created. In fact, I'll go a little step further. If you, I don't know, as we're all customers, right? You make let's say you have a problem and you call a customer service line. You explain your problem. They listen to you and they say, let me put you on hold and get back to you. They either get back to you and say they need to transfer you to somebody else, or the line goes dead and you have to go call back and re-explain it. That's basically why Bank of Georgetown is here. We work with all levels of businesses, all size businesses. Some of my partners up here do the microloan piece of it. And our loan size can be smaller as well, but generally speaking, $250,000 and more is the size loan that we're looking at, but it can be smaller. I'll give you just kind of a basic outline of the things that when I'm sitting with the business owner, what I want to hear. Number one is purpose. I want to hear, why do you need the loan? What's it for? And how's it going to improve your business? Try to quantify it as much as possible. Secondly, can you afford it? Mm-hmm. Extra capital is always good, but can you afford the capital? Historically, could you have afforded it? Can you afford it now? And in the future, are you going to be able to afford it? And afford it means you have to look at two things: the servicing, the interest payments, and possibly principal and interest, but also the reduction or payoff eventually of that line of credit or term loan. The next thing that sometimes can be a challenge for business owners, but is actually critically important, particularly in the small and medium-sized business categories, is you. If you're the business owner, you're the business, period. End of story. I don't care if it's an LLC, a corporation, board of directors, you're the business, and you need to be willing to sign on behalf of the company. You need to be able to stand behind the loan. And so sometimes people are surprised by that. That just means if the business doesn't work out, you need to be able to stand behind the loan. When we start talking about collateral, it's, we talked about, can you afford it? Are you able to make the payments for the loan? What's the worst case scenario? And so a traditional bank will look at you, look at the business and see what assets you have. It may include accounts receivable, equipment, potentially real estate. All those can be in the mix on what we count as collateral. Sometimes if a business is growing quickly and you don't quite have the capital or the cash flow to help you continue to grow, we can use a program like the DC Collateral Support Program to boost up that category. So you still need the purpose, you still need to afford it, we need you behind it, but if collateral is a little bit short, then that's when the DC Collateral Support Program can come in. So it's not like we don't look at all the other categories. They're all super important, but that helps bolster that particular category. And a lot of times that's a big thing. A lot of times collateral can be the shortfall for a lot of small businesses, particularly ones that have only been in business for a few years or are growing quickly. Secondly, and I said this a little bit earlier, but it's critical to demonstrate why the loan is going to help you and have detailed projections. So you're dealing with detail-oriented people. Everybody up here is going to be, we always want to see your financial information, as much information as you can give us and in order, and preferably electronically over email after we have an in-person meeting, the better. And that makes our decision a lot easier.
Thank you. Sí.
Okay, so once again, Latino Economic Development Center, the name of our organization. And I thought I sketch out just characteristics of our microloan program and then move to, I feel like my takeaway for today is what do I think of as a loan officer? How do I analyze and approach each one of these opportunities that I see in front of me? So if you can have a little bit of insight, I guess, is what I'm trying to offer this morning. So let me first sketch out the lending program itself. So we're a CDFI, a community development financial institution. So LEDC is a private nonprofit. And right now it's really exciting. Our portfolio just surpassed $2 million. So that happened within the past couple months. We have been lending money since 1997. So we have a fairly long history. And what's important to know is LEDC, Latino Economic Development Center, we don't just lend to Latino borrowers. It's a question that we get fairly frequently, but our portfolio is extremely diverse, not only in terms of the types of clients, but the types of businesses. I would say most commonly we're seeing hair salons, landscapers, daycares, digital signage. And so we kind of run the gamut in terms of who is walking through our doors. But most of our clients have a lot of attributes in common. So keeping in mind that we're the kind of an alternative lender, because clients are coming to us because they may not have the type of fixed assets or collateral that a bank is looking for. They may have trouble with their credit history 5 or 6 years ago, but now are on time with everything. So I like to view our program that we have very high standards in terms of we want to know what your business is and who you are, but we have a little bit more flexibility when it comes to lending. So the loan product we offer is really straightforward because we only have one loan product. We only offer fixed, fully amortizing term loans. So that's all we do. So it keeps it really simple. We don't do lines of credit or any other loan product. So when you go through our program, you're going through the same process because we have, like I said, one product. Okay, so now I'll move a little bit into thinking as a loan officer. How I often think if I'm a small business owner, how can I best be prepared to have that conversation with the loan officer? Well, what do they look for? How are they analyzing me? So I've come to see my job, it's a lot like a puzzle. I'm trying to fit a puzzle together. And I'm not sure if everyone's familiar with the 6 C's of credit. Is everyone, have you heard that language before? Is this
go ahead,
Should we
please.
mention it? Okay.
Yes.
So what's crucial is just thinking of presenting a puzzle to the loan officer. And the 6 C's of credit start with your credit score is one.
Write them down. This is key
Okay.
for anybody that is going to apply for a loan, because those are the 6 areas that any lending organization looks for.
Exactly. So credit score is the very first one. And I can speak to how LEDC analyzes credit score. I don't think it's going to be exactly the same for all of the panelists. But for us, we look at credit score that are you currently on time with all of your current debt obligations? So in my case, as a loan officer, I can have a little flexibility. If something happened a couple years ago, now you're picking yourself, you're back on your feet and all your current accounts are on time. For us personally, we don't have a minimum credit score. So we don't have a minimum threshold. That's just in our case. So I also have in my mind 5 tips that I want to leave you all with. And so my first one is just to know your credit. Be aware of the score. If you are going into business with a partner, what does their credit report look like? That's critical. I've had lots of cases where people are surprised when I pull a joint credit report and they say, oh my gosh, I had no idea. Well, you don't want to be, I guess for loan officers, we just try and avoid surprises, right? Like just keep the surprises to a minimum. We don't like to be that surprised. So credit score. So for us, credit score is very important because it's going to determine the interest rate. How expensive is the loan, the interest rate? And our interest rates will start at 9%. So depending on that number, it's going to match to the interest rate. Okay. So that's the first one. The second one, not that one C should outweigh another C, but I think this is the most critical of all of them, which is capacity. Which is what John was speaking to, and it's just showing your ability to repay this loan. As a financial institution, we want to ensure that we are going to be repaid, right? And so capacity lets us know your ability to service that debt payment. So if the debt payment is $500 a month, how can we prove or ensure that you can comfortably, and for me this is really important because we don't want to put a financial burden on you if you're going to struggle to pay it back. So as a loan officer, I view that as my primary responsibility. Is I want to see your business thrive and grow and expand, but not if it's going to mean a sacrifice or something that's beyond your means. And so we take capacity super seriously. So, and the way we look at capacity, we there's a reason behind loan officers ask for a checklist of documents, and they're pretty standard. It's tax returns, bank statements, your financial projections. Why do we ask for all those documents? It's to answer the question of capacity. And each one of those documents kind of cross-checks or cross-references another. Like if we see your income from tax returns or your ending bank statements, like do they all kind of cross-reference and match? So that's really important. The third one is, we'll say it's capital. Capital meaning how much have you personally, as a business owner, invested in your company? Because if you're coming to us for a loan, we want to know, well, what's been your contribution? Because we want to share, it's not only like share the risk, but share the opportunity. But we need to know that we're kind of not equals in it, but there's a little bit of a sharing the risk there. So for us, for example, we can't lend more than 80% of your total project cost. So if you're launching your own business and you think the total project cost is $50,000 per se, like, we can't lend more than like 30 or 40,000 of it. You need to come with some. It just demonstrates to me that you're serious about it and that you have the savings set aside to make it happen. So, okay, credit score, capacity, collateral. I'm sorry, it's
credit,
your
capacity,
your capacity, and your capital. The next one we'll talk about is collateral. Sure, collateral. So I think this is an area that makes LEDC unique too. But the reason behind collateral, we're not a collateral based lender, right? Like we want the positive cash flow of your business to service our debt. We're not really in it for your piece of equipment or your car or whatever valuable asset that you have. It's more the cash flow of the business is our primary source of repayment. If that doesn't work out, we've got your personal signature to say, okay, myself as an individual will cover this. Well, our third source of repayment, kind of option of last resort, is the asset that we have connected to that loan. And so in our case, most of our clients, actually 95% of our clients, are low to moderate income. So they don't have a ton of really expensive fixed assets sitting around. It's just not the profile of the client that we see. So we're often flexible. I would say majority of our loans are secured with the business assets. So that same hair salon, it's the shampoo bowls and the products and whatever they can offer. The restaurant, it's their kitchen equipment. If it's a food truck, it's that food truck. So we often secure loans with business assets and fully owned car titles. So you need to own your car free and clear, but that typically, I feel like that accommodates most of our clients, is some combination of business assets, fully owned cars. And so for us, that's one of the areas that we're the most flexible. However, we need to ensure that at least 50% of the amount that you're asking for is secured. So, okay, the next one is one of my favorites, and it's character. Who are you as a business owner? What's your story? What knowledge and experience and skills are you bringing to your business? And it's the one that's a little bit subjective because we don't have tax returns and bank statements to kind of support this information. But this one's really important to me. It's the one that, did you show up to the meeting on time? And were you organized? And were you forthright? And because as a loan officer, we have to be your advocate. And so we have to be the one saying, like, I believe in this person, because we have to present a case to our director or to the lending committee that supports you at the end. So, and character for me is the best part because it's getting to know you as an individual. So let's see what other one I'm missing.
I think those are it.
Is that it? Okay.
So there are 5.
I think this is conditions, exactly. So this is the one that I tend to forget about, but it's conditions, which I view as just all of the external factors that may affect your loan. So if you're in the transportation business, what's the price of gas, and is it going to affect your projections, or more like macroeconomic variables that are sometimes beyond your control, but how do they impact the industry that you're in, what you're trying to do? So, but for me, like that's the heart of it. So it's just interesting insight to know that when you have a conversation with a loan officer, know that in our minds, we're weighing and putting together that puzzle all the time. All of those factors at the end have to come up with a result that's kind of the stamp of yes, like let's support them and move forward. Am I over time?
No, no, but I think that was
Okay.
key to understand what comes next. So we're going to go now with Tim to share the programs that are available at WakeIF, and then we'll talk about the collateral.
All right, I have a hard time sitting still for too long, so I'm going to get my exercise in while I give my 3-minute pitch. I'm also not going to try and stand in this blue light. Hello again. So WakeIF, I'm going to say that 5 more times in my pitch so you'll remember it. WakeIF is a community development financial institution just like LADC. We do roughly the same type of lending as LADC and as Bank of Georgetown. It's debt financing. So we expect to get paid back at some regular interval. And when I was thinking about the tips, and I really appreciate Christina just dropped some knowledge here on all of us about the C's. There's one that I find particularly interesting, and I want you to put yourselves in my shoes. I want to know how I'm getting paid back. Drop the mic, walk away.
Yeah.
That's it, right? Now, it's not the only thing I'm going to consider, and WakeIF is a mission lender, so we're looking at job creation. We're looking at what you're doing in your community and how you're serving a greater good. But the deal will never work if I don't get paid back. And that's just not the way that the system is set up. That's not the way that, we can't stay serving the community and serving our mission if we lose loans. So we need to know how we're getting paid back. And anybody who's going to give you financing, whether debt or equity, that's what they want to know. How they're getting their money back with interest, and how do they serve that next person coming down the pike. And WakeIF is flexible in our structure. We do lines of credit. We'll do term loans. To tell the difference, you figure out how your cash flow is coming in, and that's how we're going to structure it. So if you have receivables that you're basing on, say, a government contract, we're probably going to have a line of credit that we are going to time to that receivable cash flow. If you are buying a new piece of equipment that's going to last you 5 years and increases your capacity, then I'm probably going to term the loan to 5 years and have principal and interest. So there's a lot of flexibility in it, but what's the one non-negotiable point for WakeIF? How do I get paid back, right? I do not have a money tree in my backyard that produces money on a consistent basis. I have to go out and raise capital, right? We're not dissimilar in that WakeIF has to go out and raise capital, and I have investors. Now, those investors have a social responsible mission, but I can't tell them that I lost their money, right? So one more time, what is WakeIF? What is our non-negotiable point?
How you're going to get paid back.
Drop the mic, I'm done.
Thank you, Tim. Okay, so now that we have an understanding of kind of what lenders look for, let's take a look at the collateral information here from the District of Columbia, and then we're going to hear from a personal case, and he's going to share with you how he got his loan, the kind of collateral he's got, so it closes like the loop. So Chester.
Okay, so to keep it interesting, I hope you don't mind if I sit, okay?
No, go ahead.
You had the stander as a walker, so I guess I'm the sitter. Just so I don't miss some important information, I just want to, be able to check my notes. So first of all, again, I just want to state that I'm here from the Department of Insurance, Securities, and Banking. And so we're your local regulators here in the District of Columbia. We're not a lender. Our role is to protect, to provide consumer protection, and to regulate your insurance companies and your local banks and insurance brokers, etc., in a fair and prudential manner. If you have any issues with your insurance agent or your local bank or your local investment broker, etc., I believe we have some information handed out because part of our role is to ensure that you know who we are and what we do. So I believe there were some brochures handed out with our contact information, but just in case you missed it, our website is D as in David, I as in Ida, S as in Sam, B as in boy. So let me go again. It's DISB.DC as in District of Columbia.gov. So DISB.dc.gov. If you go to that website, you'll get an overview of who we are and what we do. Our main number, it's 202-727-8000. So that's my little sales pitch for the agency. Now, today you're here to learn about access to capital and financing. And so you've heard from the bankers as to some of the issues and some of the factors that they take into consideration to determine whether or not you're a good candidate for a loan. Fortunately for you, there are two programs that are affiliated with my agency. The collateral support, which is a main program that I'm going to plug today, but I also want to bring to your attention that we have a program called the the Certified Capital Company Program, CAPCO for short. It's a program where you would have to reach out to one of the lenders and indicate to them that you would like to get a CAPCO loan, and they would do an underwriting and determine if you are eligible for a CAPCO loan, and we will do a review and approve the loan for disbursement. Detailed information is on our website, and I believe in the handouts that we have provided, there is a one-page summary about the CAPCO program. It's a program that started in 2004, so I just wanted to put that on the radar. Now, to the program at hand, which is a collateral support program. I assume that everyone here follows, the national news, and you may be aware that in 2010, President Obama signed into law what's called the Small Business Jobs Act. And so that act was designed to help strengthen at the state level to provide private financing to small businesses through lending in an effort to create jobs. And so a number of all the states got an allocation from this $1.5 billion. The District of Columbia, our share was $3.2 million. And so this money is to be used to provide support, collateral support. So if you remember, you just heard about the 6 C's of credit, and collateral is one of the 6 C's, right? So if you're a business owner and you're attempting to get a loan, but you don't have the assets available to provide the necessary collateral, then this is a program that you probably could benefit from if you meet certain qualifications. It's a program geared specifically for small businesses. However, again, we're not the lender. We have currently 10 banks who we partner with. Again, there's a handout, I believe, that has a list, the names of the 10 banks. If you go to our website, you should find that information. And in a nutshell, you would contact one of these banks. You would provide your business plan, I suppose. You would go through the 6 C's, an analysis of the 6 C's. And the program is designed for those of you who would fail the collateral test. So, brief example, if the bank requires $100 in collateral and you only have $80, then this program would provide the $20 in shortfall. And there's a process that the bank would have to go through. They would have to send your loan to us. We would have to review some of the documentation. And if we deem that the loan meets the requirements of the program, then we would approve for the collateral to be sent to the bank. And so the bank would hold the $20, and if you repay your loan, then that collateral becomes available to service another loan. So the success of this program is really incumbent on borrowers being able to service their loans in order that the collateral can be recirculated within the community. The goal of the program is that this $13.2 million, if circulated properly, meaning that everyone who borrows repays their loan in time, they meet the conditions of their loan, then we're hoping very optimistically that, we should be able to provide about $130 million in lending. So that is a nutshell, an overview of the program. It's a partnership program. It requires the 10 banks who have signed up with us to actually do the underwriting and make a determination as to whether you are a candidate to participate in this collateral program. If the bank determines that you are an appropriate candidate, then the bank sends us the paperwork. We will do a review. We have guidelines from Treasury that we have to meet. And if those guidelines are met, then in all likelihood, there will be approval, the collateral will be released, and you would get your loan. I just want to remind you that we don't do direct lending and we don't make an underwriting decision. So if you apply to the bank and the bank determines that you're not a candidate, we're unable to override the bank's decision. We have no say in that process at all. I guess I'll be available for questions later. Thank you.
What are some of the banks that are already part of this collateral program? I mean, you don't do it through them. You do it through a bank, and the bank helps you through the process to get the additional collateral if they think it's a good option for you. So which are some of the banks that are already participating in the program? Do you know?
Oh, we're one.
Wycliffe. Good. That's great.
Well, I was trying not to read the name of all the banks because there are 10 banks, but I could. Again, there should be information in your handout. It's on our website. But Bank of Georgetown, Industrial Bank, United Bank, Washington First Bank, City First Bank, Amalgamated Bank, Cardinal Bank, Viva Bank, Colombo Bank, and Navy Federal Credit Union. So these are all the banks that have participated in this particular program.
Right.
Just real fast, and you said this, but just to make sure it's absolutely clear, he said he's not a lender. You guys know that. He's our regulator. But so eligibility is one half of it, and it's the underwriting piece is the other half. Eligibility, we'll screen for the program, and we'll kind of go through the check boxes to make sure that you're eligible. But when you make an application, we have our initial meeting at our bank. I'll go through and I'll talk to you about our underwriting guidelines and our standards, like we've been talking about up here. So eligibility is an absolute. There are certain criteria that the district and Treasury require, and then there are specifically by bank, there are underwriting guidelines that we look for, and then the collateral support element of that program can help us get it through a committee.
Right. And it's great that Wycliffe is part of that too. Yes. Okay, so now when we hear from St. Elmo, Mr. Crawford, and tell us your experience, and I know you got loans, so it is a great example putting together all the pieces that we already talked about to share with them what your experience was.
Absolutely. Good afternoon again, everyone. First of all, I just wanted to kind of acknowledge Congresswoman Norton. I'm a native Washingtonian, and I've been coming to programs like this since I was about 19 years old. So these programs are very useful in terms of finding out what's out there and how you can potentially use some of these programs to grow your business. Quick show of hands from everybody in the room. How many people in here actually have started a business or are starting a business? Yeah. How many people here are thinking about starting a business? Okay, so it's a good number of business owners in the room. That's great, because I can say personally, entrepreneurism is one of the hardest things that you will do in your life. It's very fulfilling, but it's a very difficult process, especially when you're just getting the ball rolling. I kind of equate it to pushing a rock up the hill. You know, those first couple rolls to get it up the hill are always the most difficult, but once you get it kind of in an area where it's close to the plateau, and then once you get it over, it's a lot easier on the way down. In regards to small business finance, really, small business finance is one of the cornerstones to any business or the growth of any business. If your business is going to be successful, or you're going to be growing your business in any measurable way, you will at some point need financing. Whether you're a contractor or whether you're a salon owner, digital signage owner, at some point along the line, you will need to find money, whether it's from a bank, whether it's from friends and family, whether it's on credit card, whatever. You'll need money to finance your business and grow your business. For us, I'll just give you a brief overview of my experience with some of the lenders here and working to try to get finance when we first started, and then also later on down the line. When we started in 2005. Doing digital signage at conferences and trade shows. And for us, the initial phase of it was really trying to finance ourselves, pulling together anything you could find, any dollar here, credit card there, to try to be able to get the ball rolling. And we were able to do that. We did that for a while. But like I said, at some point along the line, you will have to go out and find financing because a project will come up that you just can't finance yourself. And so that's really when we started looking outside the box and looking at some of the lenders that were available and the loans that were available. And it was actually coming to an event like this that I found out about LEDC. And at the time, I was younger, significantly younger when we first went out looking for financing. But at that time, I think I was like 4 or 5 years out of college, and I didn't really have a whole lot of assets. Everything that I had put into my business. And so going to a traditional bank, one of the big things that they're looking for are assets, and especially at that time, because this was when we actually went out to look for financing, it was kind of right in the wake of the financial collapse. So lending was really difficult. And so, going to bank after bank, even the bank that I had been banking with for like 5 years, trying to get a loan from them was a very difficult process. And I think I talked to Tim at Wakefield, and I talked to Christina at LEDC, and I just found that the community lenders at that time, with where we were at in our business, were a lot easier to deal with. And they were also, one of the great things about these organizations is that they're flexible. They're very creative. And that's one of the things that I hope that you take away today, especially in these days and times. You got to think outside of the box. Think outside of the box with your business, but also you're thinking outside of the box with your lending. With their deals that you can make with a community lender, and even with some of your suppliers that are not your typical arrangement, but they will work nonetheless. Because suppliers are always going to be trying to sell supplies, and lenders are always going to be trying to make loans. That's what they do. And so you really have to figure out something that will work for you and for your business within the criteria of what each of those lenders or the products that those lenders have available. But working with LEDC, like I said, we came to them. They told us what they were looking for. They were very straightforward. We put together our package. We had our profit and loss statements, our balance sheet, all of our financials together, credit scores, all that stuff. And like a number of the panelists have said earlier today, you really are your business, especially when you're going after those first loans to get your business off the ground. You think you have an LLC or an S Corp but at the end of the day, it's you. And they're looking at you. They're looking at what you're bringing to the table. They're looking at your business and how your business has performed. They're looking at the past, but they're also like they said, looking at the future. One of the big things that when we got those first loans, one of the big things that we were able to do with them, because we were light on assets and collateral, one of the things that we were able to do with them is show them our pipeline. We have these clients we have contracts for these clients that are in the next 6 to 8 months. I don't have their deposits and payments yet, but we have contracts with them. So we do have a pipeline, and they were able to work with that and use that as collateral. And so, like I said, thinking creatively and figuring out what you've got that you can use to, get a loan. The other thing that I would hope that you all would take away is it's never too early to start planning. The last time that I went to Christina for a loan, we were actually in the process of trying to work out a deal with the district. They had put out a bid, and we were, going to compete for the bid, but we didn't know. You put in these proposals, and you see what happens, and hopefully something comes up. But I talked to Christina about it because it was a big bid, a lot of work, and I just knew that on our own we couldn't take that on. I couldn't pull that out of working capital. We really needed to get some financing. financing if we were going to be able to do this project. And so I told her when we first started putting the proposal together that this thing might be coming down the line. I don't know, if it's going to pan out or whatever, but, just giving you the heads up. And then I think like 4 or 5 months later, we were awarded the contract, and they wanted us to start work like immediately. So we went from 0 to 60 in a couple of days. I called Christina up. I told her, we've got this project coming, but because she already knew that we were working on it, she had already kind of started prepping people at LEDC. They already had all of our stuff pulled. All I had to do was give them our latest financials, and I think we were able to get the deal done in like 15 days or something. Which for us was critical because we had to get product, we had to get services over there immediately or risk losing the contract. And so for businesses that are both starting and businesses that are in business right now, it's never too early to start thinking about financing and putting stuff together. Another thing that as small business owners, because you're doing so many different things and you're wearing so many different hats, is that a lot of times we don't always keep our financials and all of that up to date, but it's something that really helps the process because you never know what's coming down the pipeline. You never know when you'll need to go get financing or when you'll need to expand your operation or even when you'll need to get new office space nowadays. So it's imperative that at least once a quarter, I mean, I know it's a lot and it's a pain, but it's great to just kind of get all of your documents together once a quarter, or when you have a little break, take some time and pull everything together, have everything in one place. So if you do need to run out and get financing or you do need to go out and do stuff, you've got those documents available. And the last thing I would say is, especially in events like this, is to think about going out and talking to other business owners. One of the best ways that I found about good financial institutions, not so good financial institutions, and trust me, I've been to all of them, is by talking to other businesses. Other business owners that have been there, done that. They can tell you good ones, good processes, bad ones, bad processes. And so you can really get a feel for, where your next move should be. And especially when you talk to businesses that are on the same kind of size, same number of employees as you are, they can give you a lot of insight as to what your next step should be. So that's really all I have for today. If you have any questions.
Thank you, Mr. Crawford. We're going to begin questions in 5 minutes. There's one more thing that I would like Tim and Jonathan to talk about, that is the startups when companies are 2 years and under, because there's some specifics there. So I think that it's important that you give like a little bit of the overview of what is specific to companies that are startups. Sure.
We have done some startups for sure. Many times when we're able to finance a startup operation, it's when someone has prior experience at whatever it is that they're doing. They're bringing a knowledge base, they're bringing clients to the new entity or to the new business. If it's a truly startup business for our commercial bank, collateral is very important. Your personal assets are very important. I think I'm going to be leaning on my partners in a lot of those scenarios. There's no surprise when you're working with a commercial bank, regulated like we are. In reality, a startup business, historical information and performance is important to me. I have to be able to show that there's some traction, there's some sales, the business is profitable. And so, it's by no means not out of the question. And I think, we've all kind of been hitting around it, but you never burn a bridge. Businesses, you start out small and you grow big. And we're all part of the financial cycle here. And so we all work together. There are different, professionals or different bankers, different lenders that provide different types of financing. So I think we should still be a part of the picture and part of the conversation. But in reality, some of my other partners are probably better fits for startup entities.
I won't walk too far this time, but we do, we'll work with startups. And I think as Jonathan mentioned, it's the management, right? It's what are you bringing to the table? What experience do you have in this business that you're saying that you're going to execute. And so, I mean, the easiest example, I always like to use restaurants, especially when I'm hungry. So, if you want to run a restaurant, just because you're good at cooking at home doesn't mean you can run a restaurant, right? Now, if you have 20 years of experience managing a restaurant kitchen, that's something I could sink my teeth into. But you have to have, I say you, but I globally, the management team has to have experience in the business that they're saying they're going to run. And if they do, I want to know about that track record then. I want to make sure that 20 years managing a kitchen was successful. I don't want you 20 years running kitchens into the ground, moving on to the next one, running that into the ground, and then you coming to me for financing to run another one into the ground. So management team gets extra scrutiny with startups.
Thank you, team. Okay, so thank you all. I think we have a great panel today, and we're going to open it to questions. We have until 1:30. For questions. So if you're going to ask a question, just please let me know who the question is going to, or if it is open, just state that it's anybody that wants to respond. Please.
I have many questions.
You want
but
the,
I'll just start with
Here, okay. Huh?
Good afternoon. My name is Tanya Crawford. I'll just pose one question because I have many questions. Can I ask two?
Yeah.
Okay.
Absolutely.
Okay.
Yes. Just say, if you can say your name, and if you can just say if you have a business or whatever, so that they know exactly, the context.
Okay. I am in the process of beginning a social enterprise here in Washington, D.C. And my question is for Mr. McPherson. My first question is for Mr. McPherson. Please excuse me if I'm just totally off with this question, but the $3 million that was allocated to D.C. for from the Small Business Jobs Act, was it spread throughout the 10 institutions, or how was that money distributed amongst those institutions?
I guess I'll just use the mic here.
Okay, perfect. Okay.
It's really a quick answer. It's a first come, first serve. So the banks have enrolled to be our partners. And so as the banks get loans that they think are qualified for this program, they will send them to us. And so we're working through the first tranche right now. It's an installment program. So although we've been allocated $13.2 million, we have to demonstrate to the Treasury that we have been dutiful and judicious in our use. So you get through the first tranche, which is about $4 million, and then we apply for the second tranche. So we're currently working through the first disbursement, but it's a first come, first serve.
And the interest that's earned from the repayment of the loans goes back into the program?
It goes back into the program. And the whole idea is that if successful, this will be an evergreen, long-lasting program where you're recycling dollars over the years to come. But, it's a partnership. So the businesses that are invested in will have to be successful, and we will have to be successful managers of that program as well.
Is there any special type of, I'm so sorry. Okay. Is there any type of special designation for the funds besides just the lending? Like, is there a portion of the money that the institutions were given for community engagement, sponsorship, anything like that?
The program is flexible under the Act, but currently as designed in the District of Columbia, it's strictly to provide collateral support.
I just want to jump in too, because it's not, I believe I would have been the first to sign up if it were money, a check coming to me to lend out, but it's based on individual deals. So we did not get a bucket of money. It's when we enroll them in the program, that little slice comes off into the collateral account. So that Chester got from his money tree. That credit.
Okay, we're going to get You ask loud or?
Yeah, I can
Okay.
talk about. My name is Russ Bond, and I just want to say, first of all, thank you to the panel. This is an incredible resource, and we really appreciate your time here. My question is directed towards the lenders, both on the bank and the community development lenders. Why would, if a person is lucky enough to have the option to go with either a bank or a community lender, why would we go with one or the other? I think one of the things that sticks out to me in the commercial lending rates, I think around 6.5, with the community lending rate at about 9%. So I think that would lead one towards the other. But I want to hear from the panelists just in terms of the flexibility and options and tools that are available. Again, if you're able to choose from different lending institutions, why would you go with one or the other?
Sure. I mean, the community development model only works if the bankable deals get to a bank. And it's going to be the cheaper form of capital anyway, which I think you alluded to. And, Christina and I are working in a similar world, but, our interest rates are similar. Ours I kind of fall a little bit lower in that spectrum, but I bet, 8 days a week and twice on Sunday, John is going to be our best interest rate. Mm-hmm. And I think if you can qualify for a bank loan and it fits your criteria, I strongly suggest going that route.
Mm-hmm.
So I think
It's lower priced.
Lower price, but it's a life cycle thing. So as the business matures over the course of time, we're because we're a commercial bank, we're looking at historical information. We're looking at your balance sheet. You're a stronger business. Your collateral is probably stronger. Hence, lower risk. And so we're structured to underwrite those risks better than other organizations. We also provide depository services, online banking, cash management tools, and the full banking kind of spectrum. But interest rates, and speaking of interest rates, it's an incredible interest rate environment for commercial bank clients. Mm-hmm. Banks are fighting over each other for deals. So banks truly want to win, but, and I say but, it's, the parameters and the underwriting standards. While I think I've seen some, the underwriting standards certainly have loosened up some over the last couple of years compared to 4 or 5 years ago when things were just locked solid. But I think it's the life cycle thing. So there's always, there are other financial resource tools like factoring companies. And there's always that decision where businesses can use a factoring company, and then when do they become bankable? Because they want to be a bank, and it's a lot cheaper. But it's also a full banking service.
Right. But the higher risk, the higher rate.
Yeah.
So it's kind of attached to the risk. You want to say something, Christine? Okay.
I don't know how my voice can carry. Does it carry? Is the mic a little better?
Yes.
Okay. So for me, it's all about fit. It's fit on both sides. And so I feel like my advice would be to take a good look at your own, to your own profile of a business owner. And so to know what stage are you at right now in terms of, are you just starting out? What collateral do you bring? How strong is your credit score? What loan product are you looking for? So kind of start with all those key questions, just kind of introspectively, just looking at yourself. And then knowing that for us, we're the lender that has a little bit more flexibility. We can think a bit more creatively. So we're not as tied to regulations and we are regulated, but we're not. I don't know. I just feel like we have a little bit more room to be a little more creative. And so, like Samuel Crawford was mentioning, I looked at his future pipeline for future revenue as opposed to maybe the assets that he had, right now. And so, our program, we just really look at you as an entire individual, as a business owner, and we take kind of it's called your global capacity. So you as an individual and you as a business owner. And so, I don't know if that's helpful at all.
My industry is the specialty grocery industry, preferably east of the river. And speaking of acts, I haven't read the act, but how does the Women Inclusion Act, I think Obama created, how does that pan into all this lending business? If anybody is familiar with what I'm talking about, I'm not well read on it, but is it Women in Inclusion Act for businesses or something?
So are you talking as a minority-owned business, being a woman? I mean, there is, I don't know if she's referring like to the 8M maybe, or the certifications that are specifically targeting women-owned business.
Right, but it's an act created under the Obama administration, Women Opportunities Inclusion Act or something.
Well, there was something created on a federal level that was basically for women, and it was on a specific certification called 8M. So it gives certain priority to women-owned business to get X amount, up to an X amount of money under the federal contract. Maybe that's what you're referring to. I'm not sure. But that's the only thing that I can think of because it was newly created. It was like a couple years, and it was on a specific certification for women-owned business to do business with the federal government. And it's called the 8M program.
Okay, thank you.
We have time for one more question? Okay. Mm-hmm.
Well, one thing is, I got your information myself for weekend, but how do you get in contact with you all?
How do you get in contact with us?
Yeah, what is it? How do you spell weekend?
Oh my gosh, this is a great time for a shameless plug for Wakefield, so thank you, sir. WACIF, the acronym is WACIF, as in Foxtrot. WACIF, the website is wacif.org. I'm happy to give you the phone number if you'd like. It's area code 202-529-5505. Also, one of my colleagues is here today. I believe we have a booth, Jeremy, and you can go and harass him. And but wacif.org, WACIF.org.
Mm-hmm. One of the things also that is important is that a lot of these organizations provide assistance, so they can help you to build up a business plan. If you're not there yet, they can give you some assistance to get you ready for to get a loan, even if it is through WACIF or a micro loan or through a bank. So they can guide you through the process. I always think that whenever you can put an idea in numbers, you have something going on. So there's a lot of, even the foundation that the chamber has attached to it provides assistance to businesses in the district. So go ahead.
What would, you say you have to have experience in anything? If there's a new venture that you've never even done before, and you kind of figuring out how to do it, and you're low level, what advice would you give to start on the plan or get involved in it, or what would you do from that?
I mean, I don't want to be an a-hole, but keep working. I mean, and not to be flip about it, but if it's something that if you haven't proven the concept yet, and you're asking me to share in that risk, that's just not the type of financing that we do. And I'd want to see. I think John and Christina, I think illustrated this point well. Is we want to see buy-in from your end, and I can't. My model. I mean, keep in mind, we're a nonprofit, but I still have to make more money than I pay out, and I have payroll to make, and I have the same responsibilities. So I can't take that type of risk on startup businesses, which are inherently risky anyway. So I would say keep working, but make an appointment with us, and let's talk through your financial situation. Let's talk through the operational goals and dreams that you have, and let's put a plan in place that maybe not right now, but a couple months down the road or a couple years down the road, we can have that conversation. Once there's a model that we can clearly identify, and you show us how you pay us back.
But no, we have time for one more. We have until 1:30, so please. Mm-hmm. Go ahead.
Well, what is a good option for startups who don't have bootstrap money or venture capitalists or angel investors? What is a good option? Loan partners?
I mean, start small. It's probably using the restaurant example, because I'm obviously very hungry now. Starting out with a 300-seat restaurant is too much, right? Maybe you do some small-scale catering events. Maybe you do, you kind of pare down to a model that you can afford and that you can show your ability to take inventory in on one side, transform it, add value, and sell it to somebody on the other side.
Well, to get the capital, my question is, who would you attempt to get a loan from if you don't have that history, that lot of investors?
That's a
Sure.
tough.
I mean, actually, I think it's more of it's not even a question about getting a loan from. I mean, the spectrum only goes so far. And I think what I'm talking about for a business to enter into the conversation of debt or equity from another entity or institution, there has to be a model that's there that fits within our framework. So the short answer is actually
It's a tough one.
there.
Yes, it's not there.
Well, if
Equity with your own cash.
Same. Okay.
Right. I'd also like to jump in because in my former life, I also worked as an advisor to small businesses. And I think that before you get to the issue of, am I qualified for an equity investment? Am I qualified for a loan? One of the biggest challenges I encountered with startups were the basic business plan. What is your business? What is your goal? What product are you trying to sell? Who are you trying to sell to? What have you done any market research? Do you know who your competitors are? Have you invested? Have you gone to the local business advisory council to get some guidance with putting together a business plan? And then have you put together a financial plan? Because although you may have good credit and you may have some collateral, but if you're not able to have a conversation with your lender as to, this is my vision, this is my story, this is where I'm trying to go to, then you're going to have a challenge. If you have met those requirements, and so you have a smashing business plan, you have a financial plan, then, it's how good a salesperson are you in convincing a lender to take a risk? Because at the end of the day, lending is a business decision. Will the principal be repaid? And so you have to prove that your business plan is solid, is focused, and a lender, if it's a startup, and I'm focusing here on startups, so it's a new business and you may not necessarily have the business experience. So it gets into the lender's underwriting criteria. But my experience, quite frankly, a lot of small businesses fail because the sponsors of the business don't invest the time and energy to get some financial help with putting together your business plan. So when you go in to talk to your lenders, it's really as if there's not a basis on which to make a decision.
Right. And Jonathan, and then we'll go to you. Okay.
I just kind of wanted to piggyback off of that and to the gentleman that was in the back and that had the question earlier. When we started our business, we're in digital signage. And at that time, there was no such thing as digital signage. So everything that we were doing was really an experiment. And a lot of that, going to your point, a lot of that was really, once we had something, we put a system together, we had an actual product or service, was taking that into the marketplace and seeing, could we make money on it? We at the time, like Tim said, it was all about capacity. And I think we had enough money to build one or two screen systems. And so we took those 1 or 2 screen systems to a small event and we put them up to see if, if the event would hire us to use the service. And they did. And then we took it to another one and to another one. And so at that point, we knew we at least had something viable. And if you have that, then that's at least the starting point to be able to go to an institution like WakeIF or an institution like LEDC and say, I've got something, I've got a business, I'm making some money on it, I've got everything I have into this, and now I'm looking to try to expand it a little bit.
Mm-hmm. And Jonathan.
So what Sinoma was talking about is exactly right. Think about it the other side though. So that's the core business idea. Think about your team, startups, early stage businesses. How do you build your team? Well, it's not a lot of money there to bring on extra staff, controller or other pieces of the pie. Make sure you build out your team, CPA, your tax guy, attorney, insurance. That's your team. Find the people that work with other businesses that are focused in your area or closely, or know people that are in your circles, and keep them posted. Update them with with your financial information. Send them quarterly updates. It's funny. So obviously I told you, startup businesses are challenging for our bank. But I have had a couple, not a lot, but a couple startup businesses that were thinking 5 years from now. And this was a couple years back, and they're still doing it. And I hope one day to be able to work with them. Every quarter, they send me their financial information. Mm-hmm. And I'm like, we have a great relationship, and it's understood that it's not quite a fit at this moment, but they're thinking ahead, and they know that in 3 years, then it's not going to be just John Higgins who's going to want their business. There's going to be lots of other bankers that are going to want their business. So think about now, think about building your team out, think about risk, because it's mitigating risk. Mm-hmm. And that's what all those professionals help you do, including the people up here as well.
Yeah. Thank you very much. Well, we have time for one last question and then, okay.
Mr. Crawford, what was your initial capital injection into your company, and how much risk did you personally take on to get everything started?
When we first started, I think we had between us, it was myself and my cousin, I think between us, we had about like $5,000 that we had saved up from some jobs and from working. And when I came out of school, I always had this idea that digital signage would be big one day. And so I would always keep, putting a little bit of money away. And, we had credit cards. And so we were, like I said, none of this stuff had been proven. And at that time, there was really no digital signage systems. You couldn't go to the store and buy any of this stuff. And so we would buy a screen here, buy some software here. I had a friend that was a programmer. He would help us put some stuff together. And so, we scraped and scrounged with, I think, between us, maybe about $8,000 of cash and credit. And with that, like I said, if you've got an idea and you've got something tangible that you think can be a product, that's really once you can put something together and put it in the marketplace, that's really going to tell you whether or not you've got a business. Mm-hmm. Whether it's cleaning services or, hair salons or car deal, whatever your business is, if you can make some money off of that, that's when you know that you've got something and you can go out and start shopping that. And there was one other thing that I forgot to mention earlier, but I just thought was kind of important is, especially in my relations with the LEDC, is that relationships matter. Mm-hmm. From the first person, like John said earlier, those guys that are sending him their financials every month, every week, he knows them. He sees them. They're on his mind. When they come to him and they're ready, he will instantly know what they're all about. He knows who they are. Just like with Christina, when I did my first loan with her, we kept in contact, we talked. And then when I came back to her, it was like automatic, because she knew exactly what I was doing. I kept up with her. And so whether you're starting your business or whether you're, 10 years into your business, always make sure that you just keep those relationships with whoever you're doing business with, because they will come back to benefit you.
Yeah. Well, thank you very much. Go ahead. 1 second. He wants to say something before we close.
And I guess this is one last point, and it's really to my startups. And I'm talking about my experience before being a regulator. Taxes, taxes, taxes. too often I have seen small businesses fall by the wayside because the owners or the sponsors of the business, they weren't current with their taxes, or the business taxes wasn't paid on time, or you took payroll deduction and you didn't make your remittances. You have to keep good books and records. If you got your first loan from the bank invested in you as a startup, and you're ready to go to refinance. If you're not able to show the bank that you've kept proper records, especially regarding your payroll taxes, your income taxes, you may be in for a big surprise. So I can't emphasize how important that is. Keep good records. Pay your taxes. Thank you.
Mm-hmm. Well, thank you. And the last thing I just want to say, relationships are key, and everybody here is here to help you and see you succeed. So if they say, you don't qualify for a loan, don't get upset. I got a lot of clients that got mad at me, but I just didn't do it, not because I didn't want to do it, it's because it was not the right thing for them. So we're here to support you. Thank you very much. Thank you all for your participation.